There are 5 United States tax codes that use the word exempt, where distributions cannot be put on a tax return. And I'm going to briefly give you not only the numbers that you could do your own research, but I'm also going to give you a little bit about what each one means. There's section 101, parenthesis A, end of parenthesis. What this talks about is the general rules of how life insurance works, the tax-exempt distributions through loans, how cash value grows exempt of taxation, and it's just the basics of how life insurance works. I understand this is the tax code that Senator Roth used to come up with the Roth IRA language. Now 101, parenthesis A, end of parenthesis, parenthesis G, end of parenthesis, talks about the living benefits of life insurance, where through terminal illness riders, whether they're through activities of daily living generated or whether it's terminal diagnosis, those distributions from the insurance company to the insured are exempt from taxation. Then there's section 72, parenthesis E, end of parenthesis. And what 72E talks about is that a dividend from a participating whole life insurance policy is exempt from taxation up until the cost basis of the policy, less waiver of premium. So if you look at the tax code, it's the last first in, first out of the tax code. So when we understand how dividends work, it's not a dividend like on a stock or a bond. It's got special treatment. Now 72, parenthesis E, end of parenthesis, the beginning of another parenthesis, the number 5, end of parenthesis, talks about how we can use dividends and surrender to basis, and then once we've exceeded the basis, we can then continue to borrow that dividend and continue the tax-exempt treatment of those distributions to the policy owner. Then there's section 2305. 2305 talks about the rules and regulations regarding irrevocable life insurance trusts, where we can actually, regardless of net worth, take the death benefit, put it in an irrevocable life insurance trust, and it is exempt from income and estate taxation on the death of the insured. And then the wonderful section 7702. This is the tax code that talks about how, in order to remain tax qualified, getting those wonderful treatments of tax-deferred growth, tax-exempt distributions through loans, and tax-free, income tax-free death benefits, and the rules of how much I can put in based on the face amount and age, 7702 talks about all of that. Brief note, 7702 in January of 2021 was enhanced. They made it better. If you look up the Wall Street Journal article dated January of 2021 through Leslie Chisholm, Wall Street Journal, 7702, it is a wonderful article you should print and you should have with you at all times, because the biggest question I get when I'm showing people how to accumulate as much wealth as they want off the radar screen of the IRS, I get, well, when is the government going to catch on to this wonderful tax treatment? They not only know it's here, they made it better 4 years ago. I sure hope this helps. If you want to learn more about how wealth works, be sure to subscribe to our YouTube channel and like our Facebook page, Tom Love, How Wealth Really Works.